President Donald Trump speaks during a trade meeting with Liu He, China's vice premier and director of the Central Leading Group of the Chinese Communist Party on Friday, Feb. 22, 2019. Trump said the two sides have made progress, warranting a pause in tariff hikes scheduled to double on Friday. Photographer, Drago, Bloomberg Photo Credit, copyright 2019 Bloomberg Finance LP Copyright 2019 Bloomberg Finance LP It appears that China is getting another 60 days before tariffs rise to 25% from current levels of 10% on $200 billion worth of goods. Or an amazing deal is in the works. What led to the 60-day extension, announced Sunday? It's unclear precisely why tariffs are on hold, other than the blanket statement by President Trump Sunday that talks are going well. One issue could be China's promise to import $30 billion worth of agricultural products over the next 12 months, an unlikely number. China does spend a ton of money subsidizing its farmers. According to the Organization for Economic Cooperation of Development, China spends over $200 billion on farm subsidies. Some of that money went to price support for things like cotton, of which the U.S. is the world's leading producer and exporter. Perhaps, if China cut those subsidies, it could find more room for U.S. farm goods, though considering some of their commodity imports sit in silos and rot, reaching $30 billion means they'd be nearly doubling imports of American farm goods. This is total pie in the sky. See, Trump to delay extra tariffs on China. South China Morning Post. Dear China, get ready for 25% tariffs. Forbes. China's stock market is beating the world as investors assume correctly that a trade war truce extension is in order. Not to mention Bonnie G's push to stimulate the world's number 2 economy as domestic growth slows. Photographer, Michael Nagel, Bloomberg Photo Credit, copyright 2019 Bloomberg Finance LP Copyright 2019 Bloomberg Finance LP China's losing the trade war in nearly every way. Forbes. What is more likely is an agreement of foreign exchange rates looks the most promising. Treasury Secretary Steve Mnuchin seems to have eked out some assurances from a Chinese delegation in Washington last week that they would not weaken the renminbi. This can be taken two ways. Either it means tariffs are coming and Mnuchin doesn't want China to beat them by weakening the renminbi to around 8-1. That some sort of new Paris Accord has been reached, with China keeping a strict fixed exchange rate in place. The U.S. seems to be happier with a stronger renminbi, mainly because it boosts its own relative competitive position, says Hans Redeker, global head of Forex strategy for Morgan Stanley. Investors often assume that a higher renminbi exchange rate would be a sacrifice or a problem for Chinese policymakers, one made in order to secure a trade agreement with the U.S., he says. Redeker thinks that a stronger renminbi is better for China because it gives the locals more spending power, increasing imports, and increasingly turning China into a consumer-led growth market. China may be willing to accept a stronger renminbi, he says. It may even promote it as it would help in rebalancing the economy. We must ask if a U.S.-China Forex Accord is in the cards, he says. If so, a stronger renminbi means a weaker dollar. This is good for emerging markets, but it's also good for U.S. exporters. Trump may be particularly tuned in on this as he has a goal of lowering the trade deficit with China, still over $320 billion. 2 years ago, at the G20 meeting in Shanghai, government financial managers tried to address problematic low yields, negative in Europe and Japan. They came up with the Shanghai Accord, a deal that led to a temporary spike in government bond yields in the advanced economies and a 5% weaker dollar. Another depreciation of the dollar is good news for many players. If China is getting the 60-day extension because of a new Forex agreement, the probability of a U.S. dollar weakening trend has increased. A shares to rally higher? A man watches the share price screen in a stock trading hall in Beijing. AP Photo, Xinhua, Weiming, Photo Credit, Associated Press. Monday could be the start of a greater rally in China's A shares. The Deutsche X-Trackers China A-Shares (ASHR) exchange-traded fund is up 20% year-to-date, while the MSCI Emerging Markets Index is up 10.2%. MSCI will announce more mainland Chinese equities to be added to its MSCI China Inclusion Index, which has a free float market cap of $745 billion. Some fund trackers are estimating between $70 billion and $125 billion of fresh active and passive inflows into Shanghai and Shenzhen-listed companies this year. Foreign ownership is estimated to reach around 10% of China's A-shares versus around 2.5% today. Using his preferred method of talking to the masses, President Trump said last week's trade talks resulted in substantial progress between the two countries. He said tariffs would not be going up by March 1, March 2 in China, as planned. China's President Xi Jinping. Many people in China's business community are concerned that Xi's trade war tactics are hurting their chances of growing their businesses at home and abroad. Fred Dufour, pool photo via AP Photo Credit, Associated Press. Last week, CNBC reported Trump and Chinese President Xi Jinping would meet at the Mar-a-Lago resort in Palm Beach at some point in March. If stronger renminbi keeps Trump happy, then the market may just have to learn to live with existing tariffs. On the bright side, investors won't have to do the extra homework involved on repricing assets in the event of tariffs doubling this year. Meanwhile, China is still stimulating its economy. Credit is on the upswing. The Securities Association of China has reached out to its members on cutting fees and taxes, which led to a significant rally in financial services stocks listed in the mainland. The People's Bank of China released their quarterly report last week that shows further bank reserve requirement ratio cuts are coming, allowing for targeted stimulus versus a broad interest rate cut.